Ladies and gentlemen, good day and welcome to Belrise Industries Limited Q2 and H1 FY26 earnings conference call. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance, and it may involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Shrikant Badwe, Managing Director from Belrise Industries Limited. Thank you, and over to you, sir.
Good afternoon, everyone. I would like to welcome you all to the Q2 and H1 of FY26 earnings conference call of Belrise Industries Limited. Joining me on this call are my sons, Sumed and Swastit, along with our CFO, Mr. Rahul Ganu, and Investor Relations Advisor from SGA. As we look back at the first half of financial year 26, I am pleased to share that Belrise has made significant strides in strengthening the position as one of India's leading auto component manufacturers. Our focus on innovation, quality, and customer integration continues to drive our growth across multiple segments. We have seen strong demand across our core business areas, leading to stronger relationships with our clientele, reflecting in both new business wins and accelerated growth in existing programs. Before we dive into the company's performance, I would like to speak on the positive impact of recent policy changes. The domestic automotive sector saw strong demand momentum over the past couple of months, driven by the festive period and the benefits of GST 2.0. The market sentiments have been positive, and we have seen this consumer enthusiasm translate to setup of new facilities for our key customers. This momentum, combined with our investments over the years, is increasingly paying off as we enhance our value-added offerings to OEMs, moving from being component suppliers to co-creators and full system suppliers into a concept we call Tier 0.5 supplier. This is evident in the strong relationships we have built with some of our marquee customers, where we observe higher content being supplied per vehicle and increased focus towards system assembly. We also continue to secure new orders across our premium and proprietary segments, both key growth drivers for us, which is evident across both the two-wheeler, four-wheeler, and commercial vehicle segments. Coming to the results, we have a record quarter with our PAT reaching INR 1,330 million. Total revenue from operations for Q2 FY26 stood at INR 20,535 million, up by 14% year-on-year, including manufacturing revenue of INR 18,601 million, which grew 17% year-on-year. Our EBITDA and manufacturing EBITDA stood at INR 2,962 million and 2,663 million respectively, with margins at 12.6% and 14.3%. As a company, there also continues to be a sharp focus on ROCE, and that translates into ROCE going up from 14.4% to 15.3% for the past 6 months. We expect to continue building on this trend to take our ROCE to a higher teens number for the next 18 to 24 months. With that, I now hand over the call to Swasti, who will take you through our business update and key order wins. Thank you very much.
Thank you all for joining the call. Coming to the operational highlights for this quarter. Firstly, during the quarter, we received an order from a leading two-wheeler OEM for their EV platform as a single source supplier. For this program, we have won orders for the chassis and DIW components. To cater to this program, we are setting up a new manufacturing facility in Chennai with supplies scheduled to begin in the Q3 of FY26. Having this facility in Chennai will also enable strong operational synergies with our existing operations in the region. In particular, we will be able to utilize spare capacity in our ACED operations, thereby improving asset utilization and achieving better operating leverage. While the revenue contribution from this facility will be limited in FY26, we expect it to ramp up to approximately 1,500 million INR at peak levels within the next 18 to 24 months. Given the sharp ramp up of this EV platform over recent months, we're confident that incremental volume from the OEM would push this peak even higher. Secondly, we also recorded a key win in our proprietary product portfolio with a new suspensions order from one of the fastest growing two and three-wheeler OEM in India, specifically for their three-wheeler EV suspension program. Deliveries are planned to begin in Q4 of FY26. While our current relationship with this OEM is relatively modest, this win is especially important. It has the potential to deepen our engagement and help us transition into a larger supply relationship over the next 8 to 12 months. This order diversifies our customer base in our proprietary portfolio and reinforces our position as a key supplier of proprietary components in the automotive domain. Third, during the quarter, we also initiated production at our Belrise plant. This facility caters to a large Japanese four-wheeler OEM supplying plastic molded parts for the existing models. In addition, at the facility, we've also won an order for the chassis for premium model from a Japanese two-wheeler OEM as a single source supplier, with supplies expected to begin in Q3 of FY26. This premium model will be fully export oriented, enabling Belrise to indirectly supply components to multiple global markets, and will also allow us to increase our content per vehicle, which would be approximately 1.8 to 2 times higher than that of a standard commuter two-wheeler. Fourth, we also secured an order from a large Indian passenger vehicle OEM, winning over 37 BIW parts for their upcoming SUV platform. This platform is expected to be one of the highest selling models in the segment. The content per vehicle for these parts is approximately 2200 INR, and the production will be serviced through our existing Pune facility. This win builds on the performance we demonstrated in delivering cross-car beams for the same OEM's EV models, and a consistent quality, cost, and delivery parameters for that program has translated into this expanded business award. Fifth, as discussed in our previous earnings call, we secured an order for long members, a high tensile structural component used in the medium and heavy commercial vehicle segment. Again, this order was for a large commercial vehicle OEM and again as a single source supplier. This order marks our maiden entry into the medium and heavy commercial vehicle space, which is an important step in expanding our customer portfolio. We're pleased to share that the dedicated facility for this program has been ramped up in record time, and we expect to reach peak revenues within the next 2 to 3 months. At full capacity, this facility is expected to generate revenues of approximately 120 million INR per month. Sixth, in our previous earnings call, we had also spoken about signing a general purchase agreement with one of India's leading electrical two-wheeler OEMs. At that stage, we were still finalizing the specific orders to follow under this agreement. We're pleased to share that we have now secured a first order for plastic molded parts under the GPA, which will be catered from our Aurangabad facility. This marks the beginning of what we expect to be a broader engagement with this OEM. Supplies for this order are expected to commence in the second quarter of FY2027. Seventh, in this quarter, we also initiated supplies for solar structures to a large global solar tracker manufacturer. The initial orders are for North America, and discussions are currently underway for additional orders in India and Europe. This again marks an important milestone in our diversification into the fast-growing renewable structures segment. What really excites us is that beyond the sector's strong growth trajectory, it has a significantly shorter turnaround time for execution. We therefore expect order conversions in this segment to materialize faster, all of which will be used using our current process expertise in fabrication and surface treatment. Lastly, another major order win that we had in this quarter was we secured incremental orders for an armored vehicle program for a leading Indian defense OEM. This order is for indirect exports to multiple countries in Asia, all of which as a single source. Further, our collaboration with the Israeli defense OEM has strengthened more. We are now discussing with them towards supplying large assemblies for their global programs. These key updates aside, for quarter 2 of FY26, we had expected numbers to be higher in September due to the festival season. However, there was a bit of a slowdown until the 22nd of September in anticipation of the GST rate cut. Different OEMs followed different strategies. Some OEMs chose to reduce production during that period, while others continued at peak levels. This led to a situation where production was gradual for a few OEMs. Secondly, one of our large European four-wheeler customers faced a cyber attack, due to which deliveries in this quarter were largely subdued. With that now, I hand over the call to Sumit to discuss our strategy in the four-wheeler and commercial vehicle segment and the broader way forward. Thank you.
Thank you. Recently, we hosted a technology show for one of India's largest and most established four-wheeler OEMs at the premises, showcasing our capabilities in sheet metal, high tensile forming, plastic molding, filtration systems, and machining. The event saw participation from over 300 representatives of the four-wheeler OEM customer, including senior management and cross-functional teams. And this has led to the initiation of discussions on further engagements. Our expertise in high tensile strength forming steel was specifically recognized for its potential in lightweighting and improving component durability. We expect these capabilities to support upcoming programs for this OEM and other four-wheeler customers as well. We continue to maintain strong momentum in the four-wheeler and commercial vehicle space and remain on track to double our revenues from FY25 levels for four-wheeler and commercial vehicle programs over the next 2 years, supported by ongoing engagements with 8 passenger vehicle and 5 commercial vehicle OEMs. Our revenues have grown 52% year-on-year in the first half of FY26, and we're extremely positive of this sector going forward along this time. At Belrise, we also intend to focus our investments across auto and non-auto applications, including consumer electronics, consumer durables, aerospace and defense, renewables, and other high-value engineered systems to steadily expand our addressable market and position us for this next phase of growth. Our operational excellence, honed through deep engagement in the highly demanding automotive industry, has enabled us to develop the process expertise necessary to expand this into new industries with greater agility and embody the strengths that we have. Let me now hand over to Mr. Rahul Janu, our CFO, to take you through our financial performance for Q2 and first half of FY26.
Thank you, Mr. Sumit. And good afternoon to everyone on the call. I'm happy to report a strong set of financial results for Q2 and H1 FY26, supported by robust demand and our ongoing operational improvements. Let me take you through the key financial highlights. Q2 FY26 consolidated financial highlights. Total revenue for Q2 FY26 stood at INR 23,535 million, up by 14% year-on-year from INR 20,687 million in FY22 last year. Manufacturing revenue for Q2 FY26 stood at INR 18,601 million, up by 17% YOY from INR 15,899 million. EBITDA stood at INR 2,962 million, up 22% year-on-year from INR 2,433 million in Q2 FY25. EBITDA margin stood at 12.6%. Manufacturing EBITDA stood at INR 2,663 million, up by 25% year-on-year from INR 2138 million, and manufacturing EBITDA margins stood at 14.3%. PAT stood at INR 1330 million, up 82% YOY from INR 733 million, and PAT margin stood at 5.7%. The company utilized IPO proceeds to repay debt of INR 15,960 million, resulting in substantial interest cost savings. Exports contributed 5.7% to our manufacturing revenue in Q2 FY26, that is INR 1067 million. Coming to the segmental performance on manufacturing front, two-wheeler and three-wheeler contributed 81.1%, PVs contributed 4.9%, CVs contributed 8.3% for Q2 FY26, and others should be 5.8%. Now, H1 FY26 financial highlights. Total revenue for H1 FY26 stood at INR 46,157 million, up by 20% year-on-year from INR 38,497 million in H1 FY25. Manufacturing revenue for H1 FY26 stood at INR 36,923 million, up 22% year-on-year from INR 30,146 million. EBITDA stood at INR 5767 million, up 19% year-on-year from INR 4834 million in H1 FY25. EBITDA margin stood at 12.5%. Manufacturing EBITDA stood at INR 5199 million, up 21% YOY from INR 4292 million, and manufacturing EBITDA margin stood at 14.2%. PAT stood at INR 2447 million, up 69% year-on-year from INR 1448 million, and PAT margins at 5.3%. Exports contributed 5.6% to our manufacturing revenue in H1 FY26, that is in INR 2052 million. Net debt of 30th September ending 2025 stood at INR 9614 million, and ROACE stood at 15.3%. Coming to the segmental performance on manufacturing front, two-wheeler and three-wheeler contributed 81.9%, PVs contributed 4.7%, CVs contributed 8.5% for H1 FY26, and others would be 4.8%. With this, we can open the floor for questions. Thank you. Thank you very much.
Thank you. Ladies and gentlemen, we will begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Saurabh Jain from Sunidhi Securities. Please go ahead.
Hello. Congratulations, management, for the wonderful set of numbers. I have a few questions. To begin with, some color on trading business apart from that it consisted of 920 odd crores in H1, and how it fared or weighed on your profitability during H1. Something which can help us to value this business and your plans to hive off this business as discussed earlier.
Thank you, Saurabh, for the question. So, the trading business grew steadily at, I think, around 5 to 6% for the half. And the EBITDA margins were in line with what we had last year, close to 6%. And this is, again, as we had discussed in the last call, consists of trading of commodities in metals and different alloys, as well as unique lithium-ion batteries. The perspective is that by using this commodity trading business, we're able to get deeper insights into global raw material indices. In terms of your question of hiving off, while we have not commented on that publicly, we are still evaluating if that would be a potential option that we could consider, and we'll keep you updated for any further updates on that.
Cool. My next question, as mentioned on the presentation slide number 10, and also you have given quite some update in your opening remarks, we have entered into SOPs of several programs during H1, and with a couple of more going forward in Q3 and Q4. So what kind of turnover these programs contributed in Q2 and in a full-fledged year, say next year, FY27, although some of these, as you mentioned, would take 18 to 20 months to ramp up fully. So what kind of revenue one can expect from these new SOPs for next fiscal?
So we mentioned on the Chennai facility that is coming up for the large two-wheeler OEM for the EV platform, where we're a single source supplier. As we mentioned on the call, that will be contributing around 1,500 million INR at peak levels in the next 18 to 24 months. When it comes to the long member facility for the commercial vehicle OEM, again, where we are single source, and it's a extremely high tensile component and very difficult to manufacture. So just to give you some color on that, while the average in the Indian industry for high tensile strength is 600 megapascals, this component is produced at around 980 megapascals. So it's 1.5 times what is the norm in the industry. We expect, again, revenues in this facility to peak around 1,500 million INR. We expect this peak to be much quicker, and we expect us to reach this peak on a monthly revenue basis in the next 3 months or so. And the third facility we've spoken about was, again, another Chennai facility that we set up for a premium two-wheeler OEM and a large commercial vehicle OEM in Chennai. That has already ramped up, and I think in the next 12 to 18 months we can enable that to get to, again, a 1,500 million INR, and at its peak can go up to 2,000 million INR as well.
So overall, 400 to 500 crore kind of incremental turnover from all these programs can be seen next fiscal?
That's a simplification, I would say. That's a simplification, I would say. I think each of these programs have different ramp-up cycles and are ramping up over different periods. So I would not be able to answer that on a point-blank basis, but I think incrementally we have defined the incremental revenue as well as how long it will take for the business to ramp up.
Fair. My another question is on borrowings. The borrowings have further gone down in September 25. So what kind of debt levels do you see by the end of this fiscal? And any revision in the capex guidance which we had given in the last quarter?
So we're not guiding on the debt. That is something that we haven't done up to now, and we won't be doing that going forward. In terms of our capex, we maintain a guidance of 8,000 million INR over this fiscal year and the next fiscal year. So no change in guidance over that.
Okay. Last question from my side. If you can share the... Yeah.
Sorry for interrupting. I would request you to rejoin for any follow-up questions.
Sure.
Thank you.
Thank you.
Participants, in order to ensure the management can address all your questions, I request you to limit your question to 2 per participant. Next question is from Aditya from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on a good set of numbers. Couple of questions. So, number one, where are we on merger of Belrise Autocomp and Eximus Autocomp? And if you can show, throw some timelines in terms of when the group entities will be transferred to the listed entity.
Yeah, thank you, Aditya. I think on Belrise Autocomp, and just to correct you, Eximus LLP, I think for these 2 entities, again, we had guided that we would like for the merger to happen or the acquisition to happen within this fiscal year. We still maintain that guidance, as we had mentioned in the last 2 calls. At this point in time, we're not able to comment on the exact time period when it would happen, but we still maintain that we'll be able to do it as soon as possible.
Sure. And, Swasthil, is there a sequential increase in debt roughly from about 770 crores to, about 960 odd crores Q-on-Q basis?
Yes, on a net debt basis, there is, but that also has to do with the fact that we had ramped up that Chennai facility and Belrise facility last year, where there was a portion of debt that was undisbursed, so it has to do with that. Since the Chennai facility and Belrise facility have ramped up in this fiscal year, that's what that increase in debt relates to. As to answer your question more specifically, whether any debt has been taken on for new projects or working capital, the answer would be no. So all of this would be debt taken on before the IPO.
Okay. And, final question,
Mr.
if you can
Aditya?
give, some... Yeah,
Sorry for interrupting. I would request you to please rejoin the queue.
sure.
Thank you. Next question is from Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you. Sir, in sheet metal, I believe 40 to 50% of the rough 20 to 22,000 crores market is captive. So you already have 24% market share, and I believe another 25% is owned by Metalman, Indocom, etc. So my question is, if my understanding is correct, then in order to outperform the OE growth...
Hello?
Yes,
We're not able to hear you properly, sorry.
Your voice is echoing a little bit. Can you repeat or maybe
Yes.
come closer to the mic?
Yes. Is it better?
Not really. Not yet.
So is this better? Hello?
Why don't you go ahead and we can try to answer.
Yeah. Let's try again. Yeah.
Ms. Radha, you can rejoin the queue.
Okay.
Next question is from Nitij from Jefferies. Please go ahead.
Hi, good evening. Thanks for taking my question. So 2 questions. Firstly, you seem to be making some good progress in the proprietary components around suspension, brakes, steering, etc. So you've got some initial order wins. What is the roadmap you see in terms of scaling up these components with other OEMs? And also, it seems you've gotten some breakthrough in some of the newer OEMs as well. So how do you see that business expanding, and is there a case to supply some of your conventional components also to the new two-wheeler OEM that you have now?
Right. Thank you for the question, Nitish. I can answer the first part of it, and maybe Sumit can answer the second part. So when it comes to the 3 components we spoke about, steering column, brakes, and suspension, when it comes to steering column, we are already quite well penetrated. So steering column is a component that's used very commonly in 3-wheeler OEMs as well as scooters. So across the top 3 3-wheeler OEMs in India, we have penetrated all of them. And we are also supplying the steering column to the highest selling electrical 2-wheeler OEM. So steering column is a space where we feel we can continue gaining share of business. And as we had mentioned earlier, since it was a monopoly beforehand, we think we can get to a 50% or more SOB in the next 18 to 24 months. When it comes to suspensions, our progress in suspensions has been quite good over the past 12 to 18 months. While we initially started with a large Italian 2-wheeler OEM, we have now expanded to another 2-wheeler OEM based in Pune, and now also expecting to expand into the 3-wheeler suspension for an extremely fast-growing 2 and 3-wheeler OEM. I think this win was around 12 months in the making, since suspension again is a proprietary product, requires very deep validation and testing to get to a level of an LOI and a PO. So the fact that we have added a third large OEM in the suspension space is an extremely positive sign for us. And coming to the braking part of it, right now we continue to supply to 2 2-wheeler EV OEMs, both of which seem to be doing decently well. I think the next step with braking would be, of course, to continue to innovate and potentially also look at further categories. Right now, we're largely working on combination brake systems. We would potentially also like to explore working in the disc braking space, but that's also work in progress, and we'll talk more about that as and when we can speak more about it. Talking to your question on going to a deeper relationship with the top 2-wheeler and 3-wheeler OEM, I think Sumit can talk more about that.
Yeah. Thanks, Asit, and thanks, Nitish, for the question. Fundamentally, cross-selling has been at the top of our priority list. The fact that we're moving towards a tier 0.5 supplier, working closely with our OEMs across different
across our product portfolio, and we're very happy. We're glad that we can offer them a wide range, not only from metals and plastics, as well as in the proprietary product, and from a strategic location of being very close to them. That is a priority and a focus area for us. And we believe that by doing so, we can actually increase content per vehicle as well and align more closely with their volumes and their strategy as well. So just want to double click on that side. Yes.
So I would just like to add a overall thought process from our side. So we are dealing with the majority all OEMs, and our approach will be to have more and more strong basket with them. And I think that is our strength, and I think we will be able to make it happen.
Okay. Thanks for that fairly detailed answer. So one more question. When we look at your first half EBITDA versus operating cash flow, so there is almost 19-20% growth in EBITDA, but that doesn't seem to have flown into operating cash flow in the first half. And there are like some of these line items like other current assets, etc., which seem to have adverse cash flow movement. Can you explain what has happened between EBITDA to cash flow in first half?
Yes, sure. So I'll answer this question maybe in 3 points, and I'll split the answer into 3 points. One would be the increase in inventory. The second would be as you mentioned, increase in other current assets, and third would be reduction in the financial liabilities. So when we talk about the increase in inventory, we kind of went from an inventory of 7,697 million on 31st March to around 9,600 million by 30th September. Of course, it's an increase in inventory of around 20 to 23%. While if you compare our revenue from the first half of FY25 to first half of FY24, our revenues also went up by close to 20%. So the inventory growth was in line with our revenue growth per se. And on top of that, there were a couple of compounding factors that added to this. Number one, as we had mentioned, one of our large four-wheeler European OEMs had a cyber attack due to which they had low production or subdued production and increased inventory levels at our end. And secondly, as you mentioned, during the September month, there was a bit of a slowdown across a few OEMs because a lot of consumers had stopped buying until the 22nd of September when the new GST rate cuts were coming into play. So that kind of led to an increased inventory level for the month of September that kind of is shown in our inventory levels for September. In terms of the second point, in terms of increasing other current assets, I think that largely has to do with an increase in capital advances, and that is largely towards the capital expenditure for our long member facility in Pune, which was being set up in this quarter, and hence the advances towards that. Secondly, also due to the tremors that were seen in the supply chain for two-wheeler OEMs, there's also supply advances to our steel and water component suppliers, which is again another large supply advance that was shown in this quarter. And thirdly, for a large European passenger vehicle OEM, we are, for some of the newer models, shifting from a domestic-based steel sourcing to an import-based steel sourcing. So when we kind of go from domestic to import-based sourcing, the advances are given again over a larger period of time, due to which they reflect that way in the balance sheet. Another factor in terms of our cash flow would be the reduction in our financial liabilities. So this year we kind of ramped up two facilities, Chennai and Bhiwadi, and we kind of paid the creditors for those two facilities, due to which there was a capital outflow for these two reasons also. So largely, I would say inventory and increase in the other current assets and the reduction in the financial liabilities, these would be the three most pertinent reasons when it comes to the delta between the EBITDA and the free cash flow.
Okay. Thanks very much, Swastik.
Thank you.
Thank you.
Next question is from Raman from Sequent Investments. Please go ahead.
Hello, sir. I just have one question. So as you mentioned in the earlier part of the call, that your trading business has around 6% EBITDA margin. And on the back of hand, if I'm calculating the manufacturing EBITDA, which is 16%. And if I'm assuming that your two-wheeler business does a margin of 12 to 13%, then your three-wheeler business, which is the new the new vertical which you are trying to you're expanding into, the EBITDA margin is more than 20%. So I just want to understand, is this margin in your three-wheeler or four-wheeler business sustainable? And I just want to understand what are the products which we are developing which gives us this margins?
I think just to correct a few of the fundamental assumptions, our manufacturing EBITDA stood at 14.3%, as is shown in our investor deck and as we mentioned on the conference call. And I don't think we commented on the fact that the three-wheeler EBITDA margin is around 20%. We usually don't comment on EBITDA margin by segment, but I would say that the three-wheeler EBITDA margin, of course, is not that high. We will not be able to comment more on this. We comment more on what the guidance is for the larger company. Yeah.
Okay. Can you comment on the last part of it? What are the products which we are developing in three-wheeler and four-wheeler segment?
Yeah. So I can comment on that. In four-wheelers, I think there's a large focus from our company on the high tensile components. Again, we acquired a company called H1, a Japanese company, on 28th March 2025. And what H1 really gave us was a deeper expertise in high tensile steel. Again, to give a 30-second brief on high tensile steel. High tensile steel allows you to go from, say, a 2 mm thickness of steel to a 1 mm thickness of steel. So you're reducing the weight by 40 to 50%. At the same time, you're increasing durability of the steel, given that it can absorb more pressure. So with H1, we can go up to 1100 to 1200 megapascals, while the India average in terms of megapascals is around 600 megapascals. So there'll be a large focus on high tensile steel in four-wheelers, given that it has a large application in EVs, given that a EV battery is heavier than an ICE powertrain. So the lightweighting onus lies on the chassis manufacturers and the BIW manufacturers. So there'll be a large focus on the high tensile steel. And the two-wheeler space, the three key components we're working on, apart from suspension. One would be braking, where we're doing combination braking systems. The second would be filtration systems. And the third would be steering columns. For all of which we have gotten our maiden orders from large OEMs. And now the real play will be cross-selling these products to multiple different OEMs.
And just
Can you repeat the third product? Hello. Sorry, I couldn't hear it.
Steering columns.
Okay, yeah.
Yeah, and Raman, sorry, just to correct, I think what you incorrectly assumed was the consolidated EBITDA at 14.3%. I think that is 12.6%, and I think that's how you incorrectly assumed the 20% EBITDA. I think that is. I think if you just look at the numbers again, it'll be clarified. It'll be self-clarified.
Yeah. Understood. Yeah. Thank you, sir.
Thank you. Next question is from Ashwin Patel from LKP Securities. Please go ahead.
Hello. Congratulations on a great set of numbers. My question is pertaining to the H1 business that we have acquired. Can you throw some light on the the revenues that we have posted in this quarter, and the margins also in this quarter which we have registered, and also going forward an outlook on this business, as in what kind of growth are we expecting in this business, and how what kind of synergies, margins are we expecting going forward in H1 business?
So thank you for the question. This quarter we had a revenue of close to 600 million INR or 60 crores in the H1 business. And right now the capacity utilization in this business is not more than 40 to 45%. So what we expect is, with almost little or no capex, we should be able to double our revenue in this segment in what we achieve today. So we feel that this H1 subsidiary can easily go to a 400 to 450 crore or 4,000 to 4,500 million INR revenue in the next 24 months. Beyond that, I think in terms of margins, we've had a bit of an operational turnaround in this quarter, and we're seeing margins inching towards our consolidated business. However, since the capacity utilization is still small, It would still take time for it to get to the larger company levels, but we are fairly confident that we'll be able to do it.
Okay, that's great, really. And yeah, I was just coming to the margins on the console basis. What kind of trend, we have reported very good, growth in the margins in this quarter. So going forward, what steady state margins are we expecting over the next 1 or 2 years? And what would be the drivers, for any kind of growth in the margins going forward?
Yes. So, we've guided for stable EBITDA margins going forward, which will be stable as compared to FY25 figures. I think the potential things that can lead to us having better margins in the future would be, of course, better operating leverage as we increase our capacity utilization. So the capacity utilization piece is already being seen in our numbers, with our ROC going up from 14.4% last year to around 15.3% this year. So a bit of operating leverage over there will definitely help our EBITDA margin. Apart from that, our foray into proprietary components like steering column, suspension, braking, filtration systems, all of which we own the IP for, will have slightly higher EBITDA margin. And also four-wheeler and commercial vehicle segments where we feel we can achieve better EBITDA margins, contingent on, of course, the industry continue to perform well in the future. The potential downsides or offsets when it comes to our EBITDA margin going forward will be the fact that we have so many facilities ramping up simultaneously. We've had Chennai facility, now we've had the Pune facility, the Belrise facility, and again a new Chennai facility. So almost 4 facilities that are being ramped up in this fiscal year itself, apart from the 2 facilities that we acquired of H1. So as a management group, we've got access to 6 new facilities, all of which will take time to ramp up, and we'll not be able to create optimal EBITDA margins on day one. So of course, during the ramp-up period, you will have less than optimal EBITDA margins, which of course will be an offset or a downside to the EBITDA margin going forward. That being said, we're still guiding for stable EBITDA margins going forward.
Okay, that's great, sir. And within the H1
Mr.
business
Ashwin,
as well as...
Sorry for interrupting. Please rejoin for any more questions.
Okay, thank you, sir.
Thank you. Next question is from Radha from B&K Securities. Please go ahead.
Hi, sir. Am I audible?
Yes.
Yeah.
Yes. So thank you again. In sheet metal, I believe that 40 to 50% of the rough 20 to 22,000 crores market is captive. So you already have a 24% market share, and another 25% is owned by Metalman, Indocom, etc. So my question is, if this understanding is correct, then in order to outperform the OE growth in sheet metal, are you betting on gaining market share from the captive and non-captive players? And if yes, then what is our right to win as compared to them?
So Radha, thank you for the question. I think we don't foresee or we don't think that the captive margin is so large as to 50 or 60%. We would imagine it would be much, much lower than the number you're quoting. The captive market existed probably a decade ago, but as players like us, Belrise, and other peers in the space have kind of migrated from a tier 1 player to a tier 0.5 player. A lot of these assemblies have come to us. So we are manufacturing and assembling a large part of the vehicle. For a large two-wheeler OEM, we are assembling almost 75% of the vehicle. So we think the 40-50% captive production you're quoting is quite high. You would assume it would be much lower. While we don't comment on competitors, I think we are number one in the sheet metal space by a large margin. So that would be the second point. And when it comes to outperforming the market, I think we've continued to do that over the past 5 to 7 years, and we'll continue doing that going forward. We have a very large lead in the two-wheeler auto component segment. I think four-wheeler would be the place where we're still quite small, where our market share will be in the lower single digits. That's the space where, we can really have a leap of growth and can outperform. And that's visible in the H1 numbers. In H1, we have, grown by 52% in four-wheelers and commercial vehicles as compared to last year. So we expect this trend to be positive, and going forward, we want to double our revenues in this space. So that will be the key driver for us going forward.
All right, that's helpful, sir. Second question is, the recent product launches suggest that there is a shift in revenue mix towards suspension products in two-wheelers. As you already have launched front fork, shock absorbers, steering columns, which covers 80% of the suspension SKU in a two-wheeler. So, however, this remains a competitive market as there are large players like Gabriel and Endurance already in this. So, what is our right to win here, and where do you see your market share in this segment in the next 3 years?
So I think so far we've had good verticalization in the space. So given the fact that we already do fabrication, machining, and assembly of components, we are able to vertically integrate a lot of the manufacturing process behind it. Another product that you missed on was that we also make springs. Springs are again a very critical and proprietary component when it comes to shock absorbers. We also make the springs in-house. So again, that's again a lever of growth that we have against some of our peers. And apart from that, we also have a strategic partnership with an Italian design firm called EDI. EDI has been working in the Indian market for more than 2 decades and has designed a lot of unique vehicles across all of the top two-wheeler OEMs in India. So we have a technical collaboration with them, through which we're able to design suspensions that are for high quality and high design capability. Maybe my brother Sumit can add more to that.
Fundamentally, in the proprietary space, innovation is the name of the game. There's an opportunity to further add value, and that is fundamentally what we do as a process expert in terms of identifying the end product and then doing the design for manufacturing in such a sense that you can add value to the end product and the end customer. That is how we've been able to add value already, and our customers have trusted us with orders there. So I understand your perspective. There are established players, however, we're making good headway already.
Sir, and the last one on the market share, sir?
Ms. Radha, sorry for interrupting. I would request you to rejoin for any more questions.
It is the same part of the question that was unanswered. What market share you are expecting in this in next 3 years, sir?
We will not comment on our market share on specific segment. I think we are commenting on our company-wide growth targets, and we'll continue doing that.
Okay, sir. Thanks and all the best to you.
Thank you. Next question is from Sri Narayan from Baroda BNP Paribas. Please go ahead.
Hi, thank you for the opportunity. So, last quarter you had put up a target to reach CPV of 17,300 in two-wheelers. So with this GST benefits coming up, do you expect to reach that target meaningfully faster, and by when?
So we've already reached that target for select OEMs. For steering columns, as we mentioned, we're working with 4 OEMs, for filtration systems with 2 OEMs, and with braking again for 2 OEMs. So I think we've already reached the target for select OEMs. This transition from 12,500 to 17,300. I think now the real opportunity is to cross-sell and add more OEMs across all 3 commodities.
So at an organization level, what was the CPV last quarter, if you can comment? In both four-wheelers.
Can you rephrase the question?
So content per vehicle in two-wheelers, what was it in second quarter, and similarly for four-wheeler, if you can give out that.
So we can only comment on optimal CPVs, which is the peak CPVs that we could work on. So with two-wheelers, as you mentioned, 17,300. And in four-wheelers and commercial vehicles, it was around 30,000, but with H1 coming in, it has gone up to 45,000.
Okay. So that's the peak but average, if you can give, I wanted to know the average with all the OEMs.
It's extremely difficult to quantify an average because different OEMs follow different sourcing strategies. So that is something that we don't track at a company level.
Okay. And lastly, you highlighted that in last quarter that CBS will have incremental CPV of 2,500. Now, you are saying you will be moving to disc brake. So what will be incremental CPV there?
Get back. So we'll get back to you on the exact number, but it would be easily 1,000 to 2,000 rupees higher.
Okay. Okay, fine. Thanks.
Thank you.
Thank you.
Next question is from Vijay Pandey from Nuvama. Please go ahead.
Hi, sir. I have just one quick query. It's regarding JLR. So the JLR, the production was impacted this quarter. So did you had any impact from the same? And are we expecting to see the ramp up from Q3 onwards?
So yeah, JLR, there was a issue into JLR, and because of the cyber attack, they kept the production hold for some time. So definitely this was something new to everybody, and it took some more time. And now the issue is resolved, and there has been a start of production, and it will be sustained progress.
And so secondly, on the margin side, so since we are now ramping like the two plants that are still like in the startup phase, so do we expect any incremental cost from these until the entire ramp up is possible? And when do you expect to see the full ramp up or like say 60-70% utilization of these plants?
So I'll go one by one. The first Chennai plant that we started in Q1 of FY26, that we say expect to continue ramping up to 60-70% by the end of this fiscal. When it comes to the Belrise plant, that has literally just started in this quarter, so that ramp up should also take another 6 months or so. When it comes to the Pune long member facility for a large commercial vehicle OEM, that ramp up has been particularly sharp, and we've been able to make some very good profits over there, where we expect to hit high capacity utilizations in the next 2 to 3 months. And lastly, coming to the new Chennai plant that we just announced, that will go into production in the third quarter of FY26, and say that will continue ramping up over a period of 12 to 15 months, because the models being manufactured over there are being shifted from another facility for the OEM. So we'll be waiting for the shifting to happen completely, and then we'll be able to ramp up fast.
Okay. Okay, sir. That is all from my side. All the best for upcoming quarters.
Thank you.
Thank you.
Next question is from Khush Shah from B&K Securities. Please go ahead.
Yeah, hi. Congrats on a great set of numbers. I just had a couple of questions. On the export side, currently you'll have around 6% revenue contribution, and with H1 India acquisition, so does that open our TAM to the Japanese market, or will this be specific for the domestic segment?
I think the TAM for the domestic Japanese market definitely opens up, while H1 largely works with one four-wheeler Japanese OEM and one two-wheeler Japanese OEM. We're in discussions with another Japanese four-wheeler OEM and another Japanese two-wheeler OEM for the initiation of orders. So in total, we'll be working with two Japanese four-wheeler OEMs and two Japanese two-wheeler OEMs. So that itself will expand TAM considerably. Beyond that, a lot of these Japanese OEMs that we're talking about are looking at India as a central production hub for supplies into Asia and the rest of the world. So we expect them to continue exporting more from India. So per se, it will not be a direct export that we do, but an indirect export, where we say supply to the Indian facilities of these Japanese OEMs, and then they export outside. And maybe Sumit can add more to that.
Yeah, and obviously also opens up the opportunity to look at direct exports. Now there's an increasing trend of vehicles and parts manufactured in India that are being exported to right up to Japan and flying on the Japanese roads. So that definitely is directionally a very, very positive sign, and we stand to benefit from it, and we see that coming our way.
Understood. Got it. Thanks. And my next question would be on the non-automotive segment. I think you all have touched base upon the aerospace and defense segment. So can we get some more insights on the non-auto side?
So all we can comment on that is there's a few things that are in the works there.
So I think the two things that we announced right now was the increased orders for the Indian defense OEM for their armored vehicle programs. So that again is an indirect exporter order where we're a single source. And again, this order was, I think, more than 9 months or 10 months in the making, and we're finally won this order. So again, while the order itself may be modest, I think important from a capability perspective, which is important to us. And second, for the Israeli OEM, we continue working on larger assemblies. I think initially the order that we had gotten was for some smaller bracketry and smaller VIW parts. But now we are thinking about, launching and exporting larger assemblies to them, and for them to make India an import hub for them in Israel.
And if I can comment on something else, there's something else in the works as well, which there's multiple things that are in the works, which we'll expect to share with you in due course.
Sure. And just one last question was, I think in the investor presentation you mentioned that you all have started supplying for the solar structures. So incrementally on the non-automotive side, like from, let's say it's right now at a base of 100, in the coming couple of years, how much do you all expect that to scale up?
While we can't comment on a specific number right now, I think we as management are fairly confident on a sharp increase in the realization and the revenues in this space. I think we would think that the automotive manufacturing industry or component manufacturing industry is probably one of the most demanding or rigorous industries in terms of manufacturing excellence. Now that we have learned the know-how from the automotive component industry, we feel that we can we can conveniently use these capabilities into these adjacent domains like the solar industry or the aerospace and defense industry, where we can use all of our existing processes like robotic fabrication, like high tensile steel forming, like coating, painting and assembly, and penetrate them fairly quickly given our process expertise. So while we can't give a specific number out today, we do expect a sharp ramp up on this going forward.
Understood. Got it. All right. That's it. Thanks, Ram. And best of luck going forward.
Thank you. Thank you.
Thank you very much. That was the last question for the day. I would like to hand over the conference to management for closing comments.
Right. So I would like to thank everyone for their time, interest and questions today. I hope we've been able to address most of your queries. We remain confident in our growth trajectory, both near term and long term, driven by strategic investments and our commitment to advancing products and technologies. For any further questions, please reach out to us or to SGA, Strategic Growth Advisors, our IR partners. Thank you once again for joining and looking forward to speaking with you again soon.
On behalf of Belrise Industries Limited, that concludes this conference call. Thank you for joining us. You may now disconnect your lines.